Partnerships. Partnerships are a simple way for two or more individuals to go into business together. So it is not uncommon for businesses to form partnerships using a contract. So this is different than a customer and a business doing a contract. It's two individuals going into business together. Okay, so it is not uncommon for businesses to form partnerships using a contract. So let's say Erica and Enrique, they really enjoyed doing business together, and Enrique says, I'd really like a marketing manager to take over and we can run this business together, and I want to expand my business, right? They might agree that Erica will handle all the marketing and product design and social media and everything, and Enrique will handle all the operations of the restaurant. And they'll get into a partnership together and they'll run their restaurant business together as partners. So it is not uncommon for people to form a partnership. But there's also a federally recognized relationship called partnership. And that's when two sole proprietors get together and they form a partnership. So often it is a contract signing by both entities outlining the nature of the business, the roles of what each partner is going to play, how profits and costs will be distributed to the members or to the entities. So it is two or more people. It's a for-profit business. That's why you set it up. So the one thing that I have to warn you about is that under liability, both partners have unlimited liability, depending on how the contract is set up. And so this is something that needs to be really discussed with both partners, is what happens if one partner does something inappropriate? Is the other partner liable? Chances are yes, unless it's defined very carefully. So we want a consideration to consider, how do we protect ourselves from our partner's actions? So we do get financing that will flow into the business through personal assets or debt financing, similar to sole proprietorship. Profits flow directly to the owner. Taxation is they have self-employment tax and personal tax, and there's federal income tax reporting. There is a partnership return, and that's typically Form 1065. Paperwork, again, is relatively simple. There is another form of partnership that we want to identify, and this may be an opportunity for you to pursue if this is something you're interested in, is there is a limited partnership. Most partnerships are general partnerships where all owners assume liability, they share the profits. But if one partner gets sued, all get sued. In a limited partnership, it's one of the partners is limited to the amount of money they invested into the business. But typically the limited partnership are times where they don't have management decisions. It does require a partnership agreement and filing forms with the state. So for example, if Enrique is starting his restaurant business and his aunt wants to donate, or not donate, invest $100,000 into the business, she might form a limited partnership with Enrique, and her liability is only limited to that $100,000. Enrique runs the business, he manages everything. If he ever gets sued for something, the aunt would only be responsible for that $100,000 that they put in if she signs a partnership agreement. The advantages of partnerships are they're inexpensive, easy to start, they share responsibilities. Disadvantages are, again, they terminate when a single partner leaves. So if a single partner decides to leave the partnership, then the partnership has to dissolve, and then a new sole proprietorship has to form, or they have to transfer it to a corporation or something. So if one of the partners leaves, then the partnership dissolves. Another disadvantage is they're liable for partners' actions and they share the profit. How is this different than partners? Partners are, it's common to confuse partnership with partners. Partnership is a legal form of organization, but partners are two or more individuals or entities that go into business together, either through a contract or formal agreement. There is a form, 20 questions to ask yourselves. that I would suggest if you are interested in partnering with somebody else to go into a business, that you answer those questions together. One of the challenges with partners is often they can have opposing goals. Maybe they didn't discuss what their goals for the future are. There's problems with communication. They have to share the profit. They have to think independently. And sometimes even if they did start off with the same vision, the vision for the business can deviate over time and change. Oftentimes there's unequal division of responsibilities, roles that can create resentment and inequality. So why do you want to have a partner? Why wouldn't you go it alone? When going and running your business by yourself, you can follow your own vision. There's more profit. There's other reasons. But why is it good to go it alone or not? It's important to ask those questions and really consider why you're forming the partner, why you're moving forward with a partner, in order to have some clarity before you decide that that is a good decision. Partners do spread the risk. They diversify the expertise or the resources that it takes to get up and running a business. And they also provide checks and balances. So somebody doesn't just have the ability to do whatever they want. So sometimes the partner's ability to question them or provide insight on and strategy on how they make decisions is really helpful to make sure that they don't make bad decisions. Oftentimes, partnerships fails because one of the individuals can't afford to hire help, so they decide to give them part of the company. So remember, if you're ever at a time where you're setting up a business and you decide to give up part of your company to another person, you basically created a partner. And so this is something that you really got to consider, is that what is the value that that partner is providing when you can't afford to hire somebody to do work that they could just get paid for. Another reason why partnerships might fail is because there was never a written and signed partnership agreement. There was never an exit strategy. What happens if one of the partners wants to leave? What do they do? Expecting it to be easy working with a friend is another reason why partnerships fail. And also having a 50-50 partnership can be really, really challenging because both parties need to agree on something in order to move forward. So how to succeed? Ask the tough questions, be honest, compare resources. That means compare what you're good at, what skills and knowledge do you have, what does your partner have? Are they both the same, or are they kind of overlapping? Are you strong where your partner is weak in a certain area? That's a great thing, right? And vice versa. Areas where you may not be skilled or expertise at, maybe they're really skilled and experienced. It should be mutually beneficial. So writing and signing in a written agreement, oftentimes just going through the process of determining what you agree on is really helpful. Having the written part of it is good as well. You will identify how partners are compensated, what are the roles, what are the responsibilities, what's the exit plan. You can establish communication plan, and you can be flexible to change. What is a partnership agreement? A partnership agreement is that contract that you sign. Sometimes you might need an operating agreement or other forms of organization to be identified. Some banks require this document so that they can see who can take money out of the bank. Some accountants might want to see your operating agreement as well, so that they can understand how partners can make decisions and who's responsible for what. Next up, corporations.